Hi, Ken AG here. Today we're going to talk about something that happened quietly in a quarterly earnings report that most of the financial media completely ignored. Hecla Mining just reported a realized silver price that is different from the benchmark price you see on your screen. And I need to explain to you why that gap, that seemingly small discrepancy between two numbers on a balance sheet, might be the most important signal in the entire silver market right now. Quick disclaimer first. Nothing in this video is financial advice. I'm not telling you to buy, sell, or hold anything. I'm walking through publicly available company filings and doing arithmetic. All right, let me start with something you already understand, because this concept is simpler than Wall Street wants you to believe. You walk into a car dealership. The sticker on the windshield says $35,000. That's the manufacturer's suggested retail price, the MSRP, the benchmark, the number the industry agrees the car is supposed to cost. But you sit down with the salesperson, and by the time you drive off the lot, you paid $39,000. Dealer markup, limited inventory, high demand in your area. The sticker said 35. You paid 39. Now which number is real? The one printed on the windshield or the one printed on your receipt? Your receipt is real. The sticker is a suggestion. And that distinction between the suggested price and the transacted price is exactly what just showed up in Hecla's quarterly report. Let me walk you through the mechanics, because most people don't know how mining companies actually sell their silver. They think a miner digs up silver, checks the spot price on their phone, and sells at that number. Not even close. Mining companies sell their production through a combination of channels. Some sell on the spot market at prevailing prices. Some have forward contracts locked in months or even years in advance. Some sell directly to industrial buyers, refiners, or fabricators under negotiated terms. Some hedge portions of their production through derivatives. And the blended result of all those channels produces a single number that shows up on the income statement. It's called the realized price. That's what the company actually received, averaged across all its sales, for every ounce it produced and sold during the quarter. The benchmark, by contrast, is the average spot price during that same period, the number that traded on COMEX, the number you saw on your screen, the number that financial media reports as the price of silver. When those two numbers match closely, nothing interesting is happening. The miner sold roughly at market, business as usual. But when the realized price comes in consistently above the benchmark, something is leaking through the cracks of the paper market. Somebody, somewhere, paid more than the screen said silver was worth. And they did it voluntarily, with real money, on a real transaction. That's what Hecla just reported, and that's what we need to talk about. Now, before I go further, let me explain why this matters more today than it would have 5 years ago. 5 years ago, silver was trading at $25. Industrial demand was steady, but not exceptional. Solar was growing, but hadn't exploded yet. The electric vehicle revolution was a PowerPoint presentation, not a production line. In that environment, a small gap between realized price and benchmark was noise. Rounding error. Nobody cared. Today, silver is a different animal. Industrial demand is at record highs. Solar installations are doubling. EV production is scaling globally. Data centers for AI are consuming more silver-bearing components than anyone projected. The metal is under structural demand pressure from multiple directions simultaneously. And in that environment, a gap between realized price and benchmark is not noise. It's a crack in the foundation of the pricing mechanism. And cracks, when they appear under pressure, tend to widen, not narrow. Now, I want to be careful here, because I refuse to do what half the channels in this space do, which is take a single data point and build a cathedral of speculation on top of it. 1 quarter of elevated realized prices does not prove that the comex is broken, or that the paper market is fraudulent, or that silver is secretly trading at $200 behind closed doors. It doesn't prove any of that. What it does prove, and this is sufficient, is that the acquisition cost of physical silver for at least some buyers exceeded the publicly quoted benchmark during this period. That's a fact. It's in the filing, it's audited, and it matters. Let me explain why it matters with an analogy I think captures the full dynamic. Imagine you live in a city where the government publishes an official electricity rate, 20 cents per kilowatt hour. That's the benchmark. It's on every government website. Every news report uses that number. But you run a factory, and your actual electricity bill comes in at 27 cents per kilowatt hour. Why? Because during peak demand, you're paying surge pricing. Because your region has transmission constraints. Because the official rate doesn't account for delivery charges, grid fees, and capacity premiums. The 20-cent number is technically accurate. It's the base rate, but it's not what you pay. And if you're making business decisions based on 20 cents, when you're actually paying 27, you're making bad decisions. You're underestimating your costs. You're overestimating your margins. You're planning for a reality that doesn't exist. The same principle applies to silver. If the benchmark says $80, but miners are realizing 87 or 90, then every analysis built on the $80 number is understating the true cost of acquiring physical silver. Every supply-demand model is miscalibrated. Every valuation framework is using the wrong input. And the longer that gap persists, the more the models drift from reality. Now let's dig into why this gap exists, because there are several possible explanations, and intellectual honesty requires that we consider all of them before jumping to conclusions. The first explanation is timing. Mining companies don't sell all their production on a single day. They sell throughout the quarter. If silver prices trended higher during the quarter, a company that sold more of its production later in the period would naturally report a higher realized price than the period average. That's mechanical, not conspiratorial. The second explanation is contract mix. If a company has forward contracts or streaming agreements locked in at prices above the current benchmark, those contracts pull the realized price higher. This is especially relevant for companies that hedged at favorable moments or that have long-term supply agreements with industrial buyers who locked in prices when they were worried about availability. The third explanation is form and quality premiums. Not all silver is created equal. A London good delivery bar commands a different premium than doré. Refined silver sells differently than concentrate. If a miner is selling a higher proportion of finished product versus raw concentrate, their realized price will naturally be higher. That's value-added processing, not market manipulation. The fourth explanation, and this is the one that makes things interesting, is genuine physical premiums. This is where the acquisition price diverges from the benchmark, because buyers are willing to pay above spot to secure actual metal. Not paper, not futures contracts, not ETF shares, metal. When industrial users need silver for solar panels, electronics, or defense applications, and they can't source it at the benchmark price, they pay more. They have to. Their production lines don't stop because the comex quote hasn't caught up. They pay what it costs to keep the factory running. And what it costs is the realized price. Now, here's the honest answer. It's probably a combination of all four. Timing, contract mix, foreign premiums, and physical premiums all contribute. The question is not which one explains the gap. The question is which one is growing. Because if the physical premium component is expanding quarter over quarter, that's not a statistical anomaly. That's a structural signal. It means the screen price is progressively underestimating the actual cost of acquiring silver in the real world. And that gap, if it widens, eventually forces a reckoning. Let me explain how that reckoning works, because this is the part almost nobody discusses properly. When the benchmark price and the acquisition price diverge, the market has a limited number of ways to resolve the tension. Think of it like a rubber band being stretched between two hands. One hand is the screen price. The other hand is what buyers actually pay. The further apart those hands move, the more tension builds in the band. And rubber bands don't stay stretched forever. They either snap back or they break. Resolution path 1. Physical premiums persist and the benchmark eventually follows. This is the most orderly outcome. The screen price gradually adjusts upward until it reflects reality. The comex quote rises to meet the acquisition cost. The gap closes from the bottom up. This is what happened historically when gold premiums in Shanghai ran persistently above London and New York. Not because someone decided to raise it, but because arbitrage forced convergence. If you can buy silver at 80 on comex and sell it for 90 to an industrial buyer in Asia, you do that trade until the gap closes. Capital flows toward the arbitrage, and the arbitrage closes the gap. Resolution path 2. Direct contracts increase and silver exits the open market. This is less orderly, but increasingly likely. When industrial buyers can't reliably source silver at the benchmark price, they stop relying on the benchmark. They go directly to miners. They sign offtake agreements. They lock in multi-year supply contracts at negotiated prices. And every ounce that moves through a direct contract is an ounce that doesn't trade on comex. It doesn't show up in the spot market. It doesn't contribute to price discovery on the exchange. The open market shrinks. Liquidity thins. And the benchmark becomes less representative of the actual silver market, because a growing portion of the market is transacting outside the benchmark's visibility. This is already happening in other critical mineral markets: lithium, cobalt, rare earths. The industries that depend on these materials got tired of price volatility on exchanges and started locking in supply directly from producers. The exchanges didn't disappear, but they became less relevant. They went from being the market to being a market, one venue among many. And the price they quoted became one price among many. Silver is walking the same path. When a solar panel manufacturer in China needs 200 million ounces a year and can't afford supply disruptions, they don't check the comex quote and hope for the best. They call the miner. They sign the contract. They pay the premium. And that transaction, the one that actually matters, never touches the exchange. Resolution path 3. Rationing. When the gap between screen price and acquisition cost gets wide enough, not everyone can source metal. Lead times extend. Product availability narrows. Dealers run out of certain forms. Mints go on allocation. This is the outcome we saw during the 2020 COVID disruption and again during the 2021 silver squeeze. Paper said 28, physical was selling for 45. And the reason physical was selling for 45 is that there wasn't enough physical to go around at 28. The market rationed through price. The people willing to pay the most got the metal. Everyone else got a wait list. Resolution path 4. The benchmark reprices sharply. This is the disorderly outcome. The gap widens until confidence in the benchmark cracks, and then the screen price doesn't gradually adjust. It jumps. It gaps. It reprices overnight to reflect what the physical market has been saying for months. This is what happened with nickel on the London Metal Exchange in 2022. The benchmark said one thing. Physical reality said another. And when the tension broke, nickel prices went vertical in hours. The exchange had to halt trading and cancel transactions. The benchmark didn't gently catch up. It detonated. I'm not saying any of these outcomes is certain for silver. What I'm saying is that all 4 of these paths are consistent with a single starting condition: a divergence between the screen price and the realized price. And Hecla just put that divergence into an audited quarterly filing. It's not a rumor. It's not a tweet. It's a number that a publicly traded company reported to the SEC. Now let me zoom out, because this isn't just about Hecla. This is about what happens when you start watching realized prices across the entire mining sector. Because Hecla is not the only company that reports this number. Every publicly traded silver miner discloses their realized price per ounce. And when you line up those realized prices next to the benchmark across multiple companies, multiple quarters, multiple jurisdictions, you start to see whether this is noise or pattern. If one company in one quarter reports a higher realized price That's interesting, but inconclusive. If multiple companies across multiple quarters consistently realize above benchmark, that's a pattern. And patterns in financial data are not random. They reflect underlying structural forces that are persistent enough to show up repeatedly in audited numbers. I want to be specific about how you can do this yourself, because I believe in teaching the method, not just delivering the conclusion. Every quarter, when major silver miners report earnings, look for two numbers: the average benchmark price during the reporting period and the realized silver price per ounce. Both are disclosed in the financial statements or the accompanying management discussion. Subtract the benchmark from the realized. That's your premium. Track that premium over time. If it's growing, the physical market is diverging from the paper market. If it's shrinking, convergence is happening. If it's stable, the relationship is holding. This takes 15 minutes per quarter, and it gives you information that 99% of retail investors never look at because they're too busy watching the ticker. This is why I built the 5-reading dashboard that we use on this channel. Policy signals, minor financials, retail stress indicators, physical premiums, and market plumbing. Because no single data point tells you the full story. But when multiple independent data streams start pointing in the same direction, the probability that you're seeing a real structural shift goes up dramatically. Right now, the policy layer is talking about critical minerals, price floors, and supply chain security. The minor layer is reporting realized prices above benchmark. The retail layer experienced enough stress that major dealers had to publicly address operational disruptions. Physical premiums at major hubs have been elevated. And market plumbing indicators, volatility, open interest dynamics, inventory drawdowns are all flashing stress. None of these individually is a smoking gun. All of them together form a pattern that is increasingly difficult to explain with the everything is fine narrative. Let me leave you with one final thought. There's something called Goodhart's Law. It says that when a measure becomes a target, it ceases to be a good measure. The COMEX silver benchmark was designed to measure the price of silver, but over decades, it became the target. The thing that traders, algorithms, and institutions try to move, pin, or defend. And when a benchmark becomes a target, it stops reflecting reality. It starts reflecting the intentions of the people who trade it. This is not a conspiracy theory. This is documented financial behavior. Banks have paid billions in fines for manipulating LIBOR, foreign exchange rates, and yes, precious metals benchmarks. The Department of Justice has secured convictions. The CFTC has published settlements. The manipulation of benchmarks is not theoretical. It is historical, legal, factual record. That doesn't mean the benchmark is useless. It means the benchmark has limitations. And the realized price is how you see past those limitations. The realized price, by contrast, is not a target. Nobody manipulates their realized price upward for fun. It's a consequence, a result, an output of actual transactions with actual counterparties exchanging actual metal for actual money. It's the receipt, and receipts don't lie. They might not tell the whole story. They might need context, but they don't lie. The benchmark is the menu. The realized price is the check. And Hecla just showed us the check. It was higher than the menu. Pay attention to that. Not because it guarantees a specific outcome, but because it means the price you see on your screen may not be the price you pay to acquire the metal. And in a market where that gap is widening, the screen price is not your friend, it's your blindfold. If this video helped you understand the difference between a benchmark and a realized price, and why that difference matters, hit the like button. It takes 1 second, and it pushes this content past the algorithm's gatekeepers to reach more people who need to see it. Leave a comment below. Tell me which signal from the dashboard you want me to cover next: policy, retail stress, physical premiums, or market plumbing. I read every comment, and I use your feedback to shape the next video. If you're not subscribed, hit subscribe and turn on the bell. Every Saturday, I publish a weekly checklist based on our indicator model, so we can analyze the mood and outlook for the following week. And you do not want to be navigating this market without that framework. Share this with someone who still thinks the number on their screen is the price of silver. Let the receipts do the talking. As always, take care of yourself and each other. And as always, build that stack.